Is owning rental real estate in a down economy a good move? You bet it is. That's today's video. Let's dive in. Hey there, I'm Clayton Morris, the founder of Morris Invest. I'm a longtime real estate investor, and I want to dive into a question that comes up often, or ignorant people that write about this on my Facebook page. When I talk about real estate investing and people say, well, yeah, but when the next economic collapses, you're going to be in trouble. Actually, no, you won't. If you're smart, rental real estate is fantastic in a down economy, and it's fantastic in a good economy. But there are four key areas that you need to know about in order to maximize your rental real estate return. Well, just first of all, let's just talk in broad strokes, and we'll dive into the four specifics in a moment. Think about a down economy for a moment, okay? If you're in San Francisco, New York, or Miami, or someplace like that, where those people who rent and pay $3,500 a month for an apartment, those are the people that typically end up losing their jobs. Or they're the mid-level managers or so forth who get knocked down and end up losing their jobs. Those are A neighborhoods, properties that I never invest in, right? But in middle America, in the great blue-collar, hardworking cities where you rent to postal employees and nurses and long-haul truckers and service industry folks, those people tend to have jobs that do not get lost. This is the case when you look at the 2009 economic collapse. Those of us who owned hundreds of rental properties in that economy did not see one dip, not one dip in our rental income. Cash flow. Cash flow is king in a down economy. People can't get mortgages, so they need to rent. Why shouldn't you be the landlord they rent from? Okay, so just in broad strokes, I want you to sort of pivot your paradigm and thinking about rental real estate in a down economy. People need to live somewhere, they need to eat, right? Why shouldn't they be renting from you? So the areas where you'll see a lot of job loss are in A neighborhoods. Those are the more affluent neighborhoods. That's the area you're going to see jobs being cut. Those are the areas where people are going to have higher vacancy rates. They're going to start leaving those big high-rise Manhattan apartments, and rental prices are going to plummet. That does not happen, though, in Midwestern markets. You may see drop in value, but you're not going to see a drop in your rent. That is the case. So with that in mind, let's dive into four areas that you can really protect yourself in a down economy if you are buying rental real estate. Number one, finance only with long-term loans. It's really important. The thing that killed people, of course, back in 2008 and 2009 is that they had those 5-year balloon mortgage notes that were coming due, and suddenly they were out of a job. They couldn't pay this mortgage in full or try to refinance. The economy was collapsing. Get a 30-year mortgage. If you need to get financing on a property that you're going to rent out, make sure you get long-term financing. That way, even in a down economy, even if the property value plummets, you're still able to cover that mortgage note, and in a few short years, when it turns back up again, you're still golden. No big deal. So get long-term amortized mortgages. That will help you out. Number two on the list, only swing at those big fat deals. That's what I love. So the properties that I do at Morris Invest, we want people to have equity when they close on a property and have a high return on investment, high ROI. We have another video here that explains, just click on it, it's in the description below, on how to figure out return on investment and ROI. And I walk you through why that number, the ROI number, is the most important thing you should look for in rental real estate. But go after the deals that you know are a good deal. Those are the deals that you should be buying, not the ones where there's a really thin margin. That means thin margins, the bigger margin for error. So number two, go for those big juicy deals that can bring you a high ROI. And number three on the list, positive cash flow. I'm all about cash flow. Cash flow is king. That is the beauty of owning rental real estate. People want to talk about having the value of their property plummet a little bit during a down economy. Okay, so if the properties I own drop 10, 15% in value, I don't care. You know why? Because I'm holding these properties for the rest of my life, and they are cash flowing $700, $800 a month from a tenant living in the property. I don't plan to sell it. So I want that positive cash flow. That is king in a down economy. So yeah, the value may plummet. Maybe I bought it for $40,000 and it's worth $50, and then in a down economy it drops to 50 or drops to 45 and maybe drops to 42, but I still bought it for 40. Or maybe even drops to 35 and I bought it for 40. Okay, big deal. The cash flow is still there. The tenant is not moving out. Where you buy properties is very important. So that's why it's very important to educate yourself on the markets which have long-term blue-collar tenants in great economies that don't really get hit by the economic strife that you would experience in some of those bigger A-class neighborhoods. And number 4, you want to reduce the amount of leverage. So look, the bottom line is you don't want to have a property where we got into trouble, right, with 100% financing. That means you have no skin in the game. You have no equity in the game at all. You do not want to finance properties at 90%, 80%. Try to be in it for, try to have some money down in that property. Try to be in it for 30% down, 35% down, 40% down. The more leverage you have in a property, the better off you're going to be long term. But again, we're holding these properties for a long time, so we're creating positive cash flow. So we don't necessarily care about the leverage position and the equity position, but it is nice if you want to refinance the property later and pull more money out of that property. So be very aware that you do not want to be fully leveraged. That's what's got us into this problem in the first place back in 2007, 2008, 2009. I'm Clayton Morris. We have a wealth of resources on our YouTube channel, so please subscribe. Click the subscribe button, and you can go through our playlist. We have all sorts of strategies and tactics to help you become a better real estate investor. And we'll see you back here. We publish videos multiple times a week, so we always try to provide as much value as we can. And I always want to end with this. Go out there and take action to become a real estate investor. Analysis can lead to paralysis. We'll see you back here next time, everyone.